Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Hey everybody, welcome back to Investing Unscripted, where we ask the hard questions about investing. Love to give our answers, and of course, sometimes we have great guests to come on to give their answers as well. We have a guest today, but before we get to that, I'm Jason Hall, joined as usual by my good friend, Jeff Santoro, he who is the voice of the people. Hey, buddy.
Hey, how you doing?
I'm good. It's a Monday. We're taping on a Monday. We don't usually tape on Mondays, but it's a good Monday. Jeff, you know why it's a good Monday?
Because I get to talk to someone other than you.
Yes, exactly. That is exactly it. And you hear the laughter from Mr. Brian Withers there in the background. We are joined today by our good friend, Brian Withers. Hey, Brian.
Hey, how are you, Jason?
I'm good, man.
And
I'm good.
Jeff, I guess. Hello to both of you.
Hello, Brian. Thanks for being here.
Yeah.
Brian is one of the three Brians that is part of Long-Term Mindset. We're going to get to some of that in a little bit. Before we get to that, though, the episode that we're doing, and I'll tell you, our conversation, Brian, when you reached out to me about something completely unrelated, and it led to the idea of you coming on, the timing couldn't have been better. And we're calling this Investing for Very, Very, Very Old People.
I love that I'm your token old person.
You said, who's the oldest person we know?
Yeah. But actually, that's completely untrue, because the reality is that Jeff and I, the age that we're at, we're where you kind of were maybe 10 or 15 years ago, like in terms of like your cadence of retirement, still kind of in the middle of like head down, net contributing, building wealth, not really close enough to retiring or getting to a level of financial independence where you're living out of your portfolio. But you're in that part where you're starting to make the transition and you're getting closer and closer to reaching a point where your portfolio is going to be providing more and more of your income. So it's a perfect conversation, because we've talked a lot about like volatility in the markets and all of those things that like we see as opportunities, and they're not always opportunities for every investor depending on where they are in their journey. So thank you for reaching out, and we're excited about talking about kind of how you manage your portfolio where you are, and think about stocks and all of the assets that you are looking at.
Awesome. Yeah. It's getting real now.
Well, and it's funny that you say that, because the thing I was thinking as we were planning for this was we occasionally will get someone who reaches out to us and isn't angry or anything, but points out that we probably shouldn't be so focused on just people who are investing in like the wealth building stage. And we actually, I think both Jason and I have gotten a little bit more careful, like when we get giddy about a down market, because we're thinking about the buying opportunity. We always sort of check ourselves and say, like, we understand that this is just for where we are in life, but it's also, you're not in retirement yet. And I don't even get the sense that you're necessarily like close, but you're definitely at that point where I think you need to start thinking about it more than we do. So I'm really looking forward to this conversation. Before we get to that part, though, you were on the podcast a while ago. You were one of our first couple guests back in, I guess it was early 2023.
January 2023.
Yeah. So you've actually never been on Investing Unscripted.
That's true. He's only been on the smattering.
That's the former name. Yes. Yeah, I've not been on Investing Unscripted.
But for, I'm sure we have people who've not listened to every single episode. I don't know why. I'm sure they will all catch up at some point. But for those who came on after episode 36, when you were on, why don't you just give us a little bit of your background, how you got to where you are now, what you're doing, where you've been, and all that kind of stuff.
My life story in a minute or less?
Yeah, perfect.
All right.
90 seconds to talk fast.
Well, I'm 57. I'm older than these other two guys. I have 2 kids, a wife. The kids are 25 and 27. The younger one still lives with us. The older one is married and lives outside of Philly. I left corporate in April of 2019. So almost 5.5 years now. and been freelancing, started writing for the Motley Fool, doing more Fool Live stuff, where I interacted with you guys quite a bit, and then joined Long Term Mindset a few years ago. And so I left corporate really. There was, I guess, a couple things. There was something was sort of pushing me, which was the grind. I didn't like the grind and the drive, and this was pre-COVID, obviously April 2019 was
People don't
pre-COVID.
drive to work anymore, Brian.
Yeah, no, apparently not.
Yeah.
My commute is about 20 steps from my kitchen to the office that I'm sitting in now. But the other piece I wanted was more flexibility. And when I left corporate, and if you go back to the other episode, we talk a good bit more about it. I took a 75% pay cut, and I'm still here. We eat regularly, and
But do you eat daily? That's
we do eat daily. We do, yeah.
Regularly, meaning once a month.
So, but on the flexibility side, they gave us flexibility to move someplace warmer and cheaper. We were in New Jersey. Yeah.
it's the worst,
kind
right?
of kind of an expensive place. You both live in expensive places.
Yeah, that's true.
But yeah, we moved to North Carolina. Mainly the two criteria I said to my wife was I want warmer and I want cheaper. And so we ended up, I live in Chapel Hill, North Carolina. We love the Triangle area. When we first were married in 1990, way back when, we lived in this area and we really liked it. So yeah, and when we last talked in January of 2023, my portfolio had just dropped 65% over the past 12 months. So that's kind of where we left things.
Yeah, I remember that conversation because we were talking about that. It was right after, that brutal 2022, and it wasn't 2023 ended up being a great year for the market, but we hadn't quite seen that yet being so early in the year. So I'm glad you mentioned that because I know I want to get to where you've been with your investment since then, but I think it would be helpful to maybe take a step back and talk about the kind of investor you were. So like maybe if we think about you as an investor by decade, maybe like what you were like in your
Yeah.
20s and 30s and 40s. And then let's talk, later about how you've been the last couple of years. So what kind of investor did you used to be? I guess is a good place to start.
Yeah, that's kind of funny that just thinking back on this, yeah, when I was in my 20s, I really had no clue. I really didn't. I knew I needed to invest. I didn't know how much, what should I be doing? Kind of all those things were very sort of nebulous and unknown. And it was just one of those things where, well, okay, let's give this a shot. And I was mainly invested in mutual funds, put stuff in the 401k, and I was also participating. I worked at IBM at the time. Participated in the employee stock purchase program, which was interesting because at the time I could start the employee stock purchase program like after I'd been with the company for a month or something. But the 401k, you weren't allowed to put in until you'd been there a year. It was crazy. It was
Huh.
it's weird back in the 90s. But,
Yeah,
kind
it's
of
amazing how much that's changed, Brian, because now companies like they
yeah.
auto enroll you and like raising your contribution. Like it's just gotten so much better.
Yes, the tools and the options for people have gotten much better, easier. Certainly, when I was buying stocks, I started in my 30s. I remember paying $10 a trade, $14 a trade, something like that. But yeah, the 30s was kind of a mix of being from no clue to thinking I'd figured things out. Kind of when I was 37, I had what I'll call the oh shit moment when you're like, okay, I've got two kids, they're 5 and 7, and I'm 37 now and I want to retire in 20-ish years. I don't know if I'm gonna get there. And the math looked really scary. And like I just was like, how is this all gonna work? And I kind of at the same time stumbled on the Motley Fool. And I remember, one of the Morgan Housel articles talk about time in the market versus timing the market. And that really hit home. And kind of at the same time, I got into individual stocks in 2004. I got my kids into individual stocks at the same time because I was like, I'm not going to let them miss the 20 years that I missed.
Yeah.
So that's another story for another podcast. But kind of at the same time, I got investing into individual stocks. They did too, and I really it jazzed my curiosity and got excited about investing and gave me hope that I could figure this thing out. So the 40s was all about piling as much money into growth stocks as I possibly could. And if you remember during that time, 2004 in my 40s, it was 2009 and the great financial crisis. And not only was I got excited about fully investing, and so every spare dollar I had, I put into stocks. I didn't worry about an emergency fund because I was fully employed and all that kind of stuff. And then the day the market hit bottom in March of 2009, I was laid off. So that was a little bit of a shock. And I ended up having to sell NVIDIA, Starbucks, you name it, a few of these names that have gone on to be great winners from there. But that was a hard lesson learned. But throughout my 40s, I kind of recovered, got a job, continued to buy stocks. I had over 100 stocks in the portfolio. And probably the investing at that time was sort of chasing the new shiny idea and buying and selling way, way too often. Kind of fast forward to my 50s and realized that what I was doing probably wasn't sustainable or nor at the same time I was looking at what my kids were doing. We were kind of buying with them once a year and just not doing anything with it. Their returns were better than mine.
They were crushing you.
They were crunching my returns. Totally. And I was like, well, maybe I need to do something different. So I worked on building an investing checklist and really honing in on what my sweet spot was from a circle of competence and making bigger bets on smaller positions. And I got down to I'm around 20 stocks today. And then I'll kind of leave it there because the last 5 years have been quite a bit different for me as well.
Well, and that's a perfect place because the next thing I wanted to ask was, and maybe this is still kind of happening, but like this is something I wonder for myself, Jason. I don't know if you think about this too. Like, I don't have a defined retirement age in my head, so I find it difficult to know, like, okay, when do I need to start thinking about if I do need to think about doing anything different? Right? Like if you knew like you had to retire at this age on this day, then you could sort
Mhm,
of backdate it and say, all right, so
mhm.
5 years before, 10 years before, 7 years before, whatever, I'm going to start to do these things. Was there a moment when you you consciously decided like, hey, I need to shift strategies here because I'm getting closer to my goal?
Yeah, well, my view of retirement and my retirement age have changed considerably since I was 22, 23. When I was 22, I was like, "I'm gonna make all this money. I'm gonna retire at 52. I'm gonna live on the beach and play golf every day." And by the time I'm 52, the kids will be out of college, and we can travel the world and
Because
whatever.
when you're 22, 52 feels like a really long
It
time away.
it does. Well, that was 5 years ago, and, that lay on the beach and buy a beach house and play golf every day hasn't happened.
Well, but we talked about this when you came on before, and I shared the story of my neighbor that lives behind us that, he's still, I know it's hard to believe, but there are people that are older than you, Brian. He's in his early 60s and he's not ready to retire yet because he's
Right.
trying to figure out what he's going to retire to.
Yes.
And that was the title of that episode was, you when you kind of went through your journey, really, I guess probably a decade before you really fully made that transition away from like being in the corporate rat race, a lot of it was kind of figuring out what your path looked like and what you were
Mhm.
moving to, right?
Yeah.
You were, when do I think about like retirement and that sort of stuff? So this guy right here, this is Tate. You can say hi,
Hey,
Tate.
Tate.
Hello.
I think you know these two guys.
How
Well,
are you?
Mr. Jeff and Mr. Brian.
Yeah.
If you're listening to the podcast feed, you can go to YouTube and you can find a picture of my son who decided to hop in my lap and participate here. Like, I got to get this guy out of the house first. I'll be eligible for Social Security, Brian, when he's graduating from college. I'm on a slightly different trajectory than you are there. So
There you go. Yeah, the retiring too, that's a really good question. And part of it was I didn't know the answer, but I knew what I was doing in corporate and where I was, our nest egg at 52 when I left the corporate world 5 years ago. I knew I couldn't continue doing what I was doing, but I also felt like our portfolio was in such a place where if I just gave it more time, I would be fine. That was
Mm.
before COVID. But so really the thing was not necessarily retiring, but giving myself a little bit of flexibility, doing something more that I enjoyed. And with the Motley Fool and the long-term mindset guys, I have tremendous amount of flexibility. And, we can go on vacation and do some of these things, but I also have income coming in. So I don't have to like worry about, I don't have to worry about drawdowns yet, which
Yeah.
is which
Yeah.
is super helpful. So I'm in sort of this in between stage, not working in corporate, but not retired. And for those folks that are interested in financial independence, retire early. I like the financial independence part, but the retire early, you got to find something that you enjoy doing to
Yeah.
keep you
Yeah.
active and your mind active. And I like this sort of state that I'm in. It's sort of this in between that, if it's beautiful out or whatever, I can go ride my bike or take the afternoon off and I don't have to really ask anybody and I can just go make it happen. And that's really been wonderful. And from a financial independence standpoint, if you can get to the place where you don't need that corporate paycheck, that's just tremendously freeing is the right word.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. Yeah, when I was younger and thought about building wealth, it always felt I never had the desire to be like a rich person. Like that was never like, I don't know. I meet young people now who are like, what do you want to do when you grow up? And they're like, I want to have a lot of money and I want to be rich. And I don't, that was never in my ethos. Like I just never, it almost felt,
Me either, Jeff. I just knew it was going to happen though.
you and I are different people. It wasn't my thing, right? So like I always felt uncomfortable talking about building wealth, but it really wasn't until I shifted my thinking away from like building wealth to have a really nice car and a big house
To
to
paying for
build,
kids' college.
right. Well, yeah, that. but also like building wealth so that I can go do something I like more
Yeah.
Mm,
or
Yeah.
that I'm passionate about when and if I want to make that decision. I happen to like my career, so I'm perfectly happy where I am right now. But, and I think that's the piece of this that I don't know really gets driven home to younger people who are like trying to make decisions about how much they want to save and how much they want to
mhm,
invest. The idea that in your 40s or 50s or early 60s or whenever, you can decide like, this career I've had has been great for me, but I'm tired of it. I don't like the rat race like you. And there's this other thing I really am passionate about. And maybe it's volunteering at a food
yeah,
kitchen or, like tutoring kids for free. Like it could be anything, but like you need the money to be able to live that lifestyle of less income. So it was a huge shift the way I thought about retirement. Once I thought about that, exactly what you just said, like building wealth for the flexibility to do something you
mhm,
enjoy more.
So let's talk a little bit about, um, not specifically like where we left off in January of, over a year ago now, a year and a half ago at this point. But the really the whole transition of going from, so there was that great period, and Brian, you and I have been massive beneficiaries of, you started buying individual stocks just a few years before me and really focused on supercharging your wealth. But you talked about the bottom of the market there, but you landed on your feet, right? You had to
mhm,
sell some, but you landed on your feet in the early 2010s and you start charging for it again. Just so happens that that March 2009 date, basically through now, has been one of the best 15-year periods that investors could have ever invested
mm,
through. So we've benefited significantly from that. So like your focus and kind of the style that you were talking about that became problematic as you began really focusing on managing and allocating and having to be more precise and thoughtful about managing an entire portfolio, probably benefited you in a lot of ways. I know it certainly benefited me. But what's changed over the past 5 to 7 years as you got to that point where it's like, okay, I'm walking away from the corporate world. I'm walking towards this other life, this other lifestyle where I'm still going to be earning income. But again, I'm not quite to the point of drawdowns now yet, but it's going to happen.
right.
How have you been? What's the kind of the thought process, and what are the catalysts that you've gone through, and what are you doing now?
Yeah, so I like to think of the stage. I really like the pioneers published something that they call
Pioneers with an F. F is in financial independence as
yes,
opposed to pioneers.
pioneers, and they
We'll have the link in the show notes, and we'll put it in the transcripts here.
yeah, this is they are also financial creators, and they were chasing financial independence and realized that as they got to a certain point in their life, they're like, "Well, wait a minute. Let me look at my nest egg. If I just leave this alone and don't do anything with it, we will get to our FI number at some point in the future, whether it's 5 years, 7 years, et cetera, and let the market do its thing." That's where I am. And that's
Yeah,
where our family is right now at a coast FI state. So I just don't touch my portfolio. I was thinking about it today. To get to my FI number, I needed to go up 50% or 60% or something like that. And to me, whether that happens in 2 years, 5 years, 7 years, I have built flexibility in my life and what I'm doing to enable to me to be patient. Whereas if I was in corporate, I would have been much more impatient and like, I got to get out of here. This sucks. I don't need this anymore. When is my money going to, get to the number that I'd need to get to leave it all behind. So kind of having this in between state has been just an absolute wonder. But also at the same time, when
so do
I'm
you feel
wrapped,
like it's do you feel like it's helped you be more objective and make better investing decisions?
it doesn't hurt that my job is helping other investors.
Yeah,
So
yeah. Kinda nice being paid to research
yeah, that
for your
that that's
portfolio.
certainly a fun element of it. But 5 years ago, very much the portfolio was all growth stocks all the time. I
Yeah.
mean, I remember I did a ranking show with some of the guys in the Motley Fool, and they're like, "Brian, does any of your companies actually are profitable?" And I was like looking, I'm like, "Nope." And so, I had been investing in early stage growth stocks. And in 2021, that looked like a brilliant strategy. Everything that I owned would go up 5% a day. I mean, it was insane. It was ridiculous. I mean,
Narrator,
my
things
portfolio, and
changed.
you're gonna like not believe this number, and I didn't believe it either, went up 147% in 1 year.
Yeah.
Like, seriously?
Yep.
And then
And then it didn't.
the market gives and the market takes away, right? Well, then the next year it went down 65%. So my brilliant, I'm so smart strategy was like, maybe this isn't so smart. And, we talked in January 2023, and that was a very much a big wake up call to me that said, I can't having experienced a 65% downturn when I'm 55, not so bad. But if I was 65 and in retirement and counting on that as income, that would have been disastrous.
Yeah.
I would have been like, selling pencils on the corner for spare change to eat.
Yeah, and
No,
that's
you could Uber.
Well, yes, have to have a car.
no, but that's exact. So I'm so glad you said that because that's this calls back to what Jason said earlier about the timing of this conversation being pretty pretty right on with what we've been talking about the last several episodes. Because last week we did over the last couple weeks we've done episodes about topics related to this, and then we did even a quick 15-minute rough cut where we just talked about the first 4 days of August, right? That last Thursday, Friday, Monday, Tuesday, where everything was kind of going crazy. And before that, we were talking about CrowdStrike because we're both big fans of that company, and it had dropped after the big tech outage. And we kept coming back to this idea of sometimes what you decide to do or not do, how impatient or patient you end up being is tied to just where you are in your investing journey. As it relates to CrowdStrike specifically, one of the things that we were discussing was, you know, both of us could make the case for people in their mid 40s who plan to retire, let's just say mid 60s, buy because
Yeah.
even if you're wrong, I mean, maybe not buy like back up the truck buy, but buy some because even if you're wrong, you have 20 years to be okay. And whereas if you're planning to retire in 6 months and that stock is 8% of your portfolio, maybe you have a different calculation. So
Yeah.
yeah, it really does call back to a lot of stuff we've been talking about.
Brian, you had a nadir back in March 2009, right? No emergency savings.
Yep.
Had to sell stocks at the worst possible time. So you had short-term money in
Yep.
stocks. And then going through this nadir coming out of 2021 where the market bottoms, which was maybe a nadir for your portfolio, but you had built more of to kind of crib from Brian Stoffel, who
Yeah.
cribbed from somebody else. You'd kind of built kind of an anti-fragile lifestyle.
Mm-hmm.
And now you'd already started that transition of shifting away from kind of the growthier side of your portfolio into kind of building more of a higher floor as part of your holdings. Let's talk about that process and exactly what you're doing.
Yeah. So I actually looked back at my numbers when I left corporate in April of 2019. I had this amount of money. And at the end, when we were doing
We can call that number more than Jeff.
more than Jeff. Okay. I had more than Jeff. And when I left corporate in April of 2019, and then when we did the show in January of 23, I actually had less money. Oh, 3.5 years later, I actually had less money in the portfolio.
We can call that number more than Jeff.
Well, yeah, and just so that the other piece of it is I am very much a stock investor. So
Yep.
we own we have a mortgage on our house and we own individual stocks, and that's it. I have cash. Those are sort of the three places where money is. And so in having less money in January of 23 was not part of the plan in April 2019.
Right.
That was not in the roadmap or the cards. And so part of that was I had started investing in dividend stocks in 2021, but it was more of a dabbling.
Yeah.
And, Matt Frankel and you, Jason, we had kind of chatted and started diving into REITs a little bit was sort of my first things. I like real estate investment trusts. I don't know if you guys have done a show on that,
Yeah. We
but
talk about it.
that's a really cool way to diversify your portfolio. And I started getting into that a little bit. And then in January 2023, when we talked about, whether it was the 65% downturn, I was like, I need to balance this growth thing that I love doing. I don't know that I'll ever stop doing, but I need some sort of barbell. You've talked about the barbell, Jason, right? I need
Yeah.
something on
Yep.
the other end to balance this crazy, more risky growth portfolio with some more stable dividend stuff.
Yeah, and because you were mentioning you have this percentage, you just have this much percentage more to get to your number, and it's probably easier to protect that with safer dividend stocks, balancing out the super risky fun stuff, so to speak.
Yeah.
So
Yeah. Go ahead, Jeff.
no, I was just gonna say, like, is it a 50-50 barbell right now? Like, if you just were kind of to ballpark it, are you still more heavily weighted towards the growthier stuff? Like, how is that kind of shook out as we look at your
Yeah.
portfolio today?
So when we chatted last time, I was about 12% into 12% of my overall portfolio was in dividend stocks, and I had two holdings at the time. There were two REITs, Digital Realty and Prologis. The portfolio since we've met, and maybe this is because I was on your show, my portfolio has gone up 60%.
You're welcome.
Yeah. So you'll have to have me back in another 18 months, and hopefully I can say the same thing.
We can call that number more than Jeff's.
More than Jeff. But
Jeff keeps
now,
muting when I make these great jokes, and we can't like he'll talk to the screen, but we can't hear his great
I keep muting
responses.
myself. Yeah, I was gonna say that we call that the investing unscripted bump, and you're welcome.
There you
there,
go.
there you
Oh,
go.
well played. Well played.
But yeah, so I was only a small percentage into dividend stocks.
One could say
Now
it was a smattering of dividend stocks.
it could have been a smatter. Well, it was only two,
Yeah.
but out of my 20, 10% of my holdings, 12% of my money was in dividend stocks. And now it's up to about 23. I have 7 different dividend stocks in a portfolio of 22. That's been a conscious over the last, I'm not in a hurry. And so kind of what I've done is I've looked at, hey, are there growth stocks like CrowdStrike? And this will be a little humble brag. As CrowdStrike was going up there, I was like, man, this is a big position in my portfolio. It looks overvalued. And so I set a limit order for, and this is like blind squirrel finds a nut every once in a while. I sold like almost right at the top a quarter of my CrowdStrike. And so what I did at that point is I take some of that and invested in some of my small growth stocks that aren't yet larger positions. I take about half of it and put it in the growth and half of it and put in and bolster my dividend portfolio. So that's kind of what I've been doing over the last year and a half. And uh, the other piece is the dividend stocks, just so that you know, are all in my retirement accounts. They're in a Roth and an IRA. And then anytime I buy a dividend stock, I'm dripping it. So I'll do dividend reinvestment. And so what's nice is that 23% has given me tremendous comfort when the
Yeah.
market does its crazy market things. And so if the market goes down, I'm like, woohoo, I'm dripping at lower prices. So this investment portfolio, the dividend portfolio, and if the market goes up, that's great. And what I've kind of seen is the beta for the dividend stocks is smaller, so they go down less when the market goes down, and they go up less when the market goes up.
We
But that's
talked about beta on a recent show, but that's the metric that's volatility
yeah,
compared to the S&P 500 typically. So a number below 1 means the stock typically moves less. When the market goes up, it go up, but probably not as much. Market goes down, it probably won't go down as much. A number above 1 is more volatile than the market. So
yeah. So I
yeah, that's
generally think my growth stocks are like beta of 2 or something.
yeah,
Some
yeah.
ridiculous, crazy, volatile number. So the beta may not be under 1, but it's certainly less than my growthier arm for sure.
So a couple things you said I want to circle back to and just kind of spend some time on. So the first thing is you mentioned it earlier, and I think I really want to hammer on it. And your situation might be a little bit different than other people that are kind of going through that same transition phase as you, where you can kind of see the point down the road where you really need to be getting to the point where you're taking distributions from your accounts. But a lot of those folks in that same age, they're still contributing. You're not contributing
Correct.
new money to your retirement account. So what that means, if we have to think about the implications here, is it means that you don't just have to get, and you run a concentrated portfolio, like you said, around 20, give or take a few stocks. You have to get not just one decision right about what you're buying, but you have to optimize for your decisions around selling. And Jeff, we've talked about selling before, and eventually we're going to do a show where I think we dig into selling maybe even more than we have, and we've done it a lot. But what does your process look like for when you think about how you have a stated goal of gradually increasing the percentage of your portfolio that's in stocks that generate income for you, but what does that process look like for identifying the companies that you want to sell? And how do you think about cash too? Because from talking in the past, I think you generally try to stay mostly invested. Has that changed? So what does that process look like?
Yeah. So I do have a decent cash cushion, probably 6 months of income if we were to, both my wife and I work. She actually works at the UNC Chapel Hill here, and we get our benefits through that. So that's really great to have a spouse who has health benefits. But having a 6 month cash cushion is so that gives me certainly flexibility and comfort in that there's cash, but that's not investable. None of that money is investable.
Right.
So I think about my investable portfolio. I'm 100% invested all the time, and when I sell something, it might be a day or two until I buy something else, but generally I know both sides of that equation and what I'm going to do.
Right. Well, you keep a watch list of stocks that you're.
Yeah. So generally, this is something that's been interesting to me as I've reduced the size of my portfolio and gotten down to like 20, is I'm much more picky, and I'm willing to take more time to either sell or take more time to buy, which has been interesting because when I was at 100 plus back in my 40s, I would buy and sell on a dime, and, ooh, new recommendation from this stock service. I need to get some. Oh, I don't have any cash right now. Let me sell off that and move into this other one.
And this was me. Like I would invent bullshit reasons to sell a stock.
I don't
Right.
I didn't think they were bullshit at the time, but yeah, they were the new shiny thing.
Yeah.
If we ever do another show on selling, and we don't have to explore this right now, but I think the three of us would have a fun conversation around this, like the things you'll convince yourself of,
Yeah.
in order to justify selling a stock.
The lies we tell.
Yeah. Here's I'll just digress for one moment. In 2010, Netflix had gotten as big, was probably twice the size in market cap than Blockbuster ever was, even at its high. And I'm like, they're done growing. Anybody who follows Netflix or the market, go back to 2010 and just put that in. There you go.
Yeah, that's I have not been investing long enough to have in individual stocks long enough to have like a story like to that magnitude. I've certainly made my mistakes selling things, but yeah, anyone I know who's been investing for a decade or more has that one they sold back in 10, 15 years ago. That
Netflix has increased its market cap 9,133%.
Well, you're just going to pour salt right in the wound.
2010. Now, I mean, the stock hasn't done as good. They've diluted investors
a little bit,
so it's only up 7,940%. Yeah.
That was dumb.
So but I'm glad you talked through because
I sold mine in 2013 to use as a benefit.
There we go.
We also have a whole episode about how you were wrong about it from a couple years ago, but
Yes.
I digress. I'm glad you talked about you, Brian, initially, and then Jason kind of driving it home about the decision process being very different when you're no longer
Mm.
contributing to your account, because that, again, to get us out of our bias, we are still contributing to our retirement account. So it's easy for us to say like, oh, that position's too big. Sure, you can trim it, but you could also just buy other stuff and
Mhm.
reduce your exposure that way. It's a different
Yeah.
calculus when you the only
Yeah,
way to reduce.
generally, it's a fairly my universe of stocks that I'm interested in investing are the ones at the bottom of the portfolio that haven't yet become full positions or another dividend stock. And that's sort of what prompted me to text Jason yesterday is I might be at the point where I would go up to 8 dividend stocks and was like, okay, what's the next thing? And what's cool, kind of I'm at the place where I am not in a hurry to make these decisions and I can leave something. I know recently I just sold out a lemonade, but that one had been on my list for like months of let me watch it. Is the thing that I'm doing, does the logic make sense of why I want to get out of this? And you know, very I plot along rather than gunslinger back in the early days is oh let's just swap this one for this one and see how it goes.
Well, Brian, that's an excellent kind of real world example of somebody that's had success doing something that Jeff and I have talked about before. And what's your mantra now, Jeff?
Don't trade, learn.
Oh, yeah,
Yeah. Yeah.
trade less, learn more.
Yeah, I like.
That's
Yeah,
Yeah.
it.
yeah.
No, that's exactly it. And but that's the reality. It's like thinking more slowly
Mm.
so you can then act decisively when you reach the conclusion. I think that's really, really valuable. So do you find yourself more likely to maybe pare down a position than to sell a full position?
Yeah, definitely pairing, yeah, trimming a little bit or adding to existing positions is mostly what I do.
Yeah. It's a
And
pretty
I
high
will
threshold for a new stock to get into the
Oh,
round with.
yeah, so that's a great question. So the other thing that I was gonna say is when you only have 20 stocks and you're looking at a new stock to come in, I know you recommended one for me to look at. I was like,
It's a
"Is
really good
this
one.
better than the average of the stocks that I have?" And because
Better than
right
19 of
now, I
your
feel
good
like the
stocks.
22 stocks that I have are
Yeah.
my best ideas.
You have 3 that might be better than this one. It's very, very good.
Brian, that is a signal to not buy the stock. Let me tell you
There
from
you go.
experience.
I got a bridge to sell you. Uh, but yeah, so when you have less stocks, you always want to increase the quality of the companies in your portfolio.
Yeah.
And so if I add one, to me, it's got to be from a quality perspective, it's got to be middle of the road or better of all the ones I want it to increase the average of the quality of the portfolio. So that's a high bar.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as NVDA and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
Yeah, it's one of the exactly what that is one of the reasons I've been trying to slowly over time pare down my stock portfolio. I mean, part of it's because it's just not a big part of my overall portfolio anyway. But part of it's that I do find myself even now it's down to 41 stocks, I think. But I used to be up over 100 too when I was
Mhm.
brand new and everything was shiny and I was trying to get a little bit of everything. But even that, getting it down from 50 to, or from 60 to 50 to 40, I find myself getting pickier and pickier and pickier as it pertains to putting new ones in,
Yeah.
because it's that same calculus, a little bit different because I have almost twice as many as you do. But like when I have new money to invest, it's that decision of like, is one of the stocks I already own that I have a lot of conviction in that's not a big position yet, is that the best place for this money?
Mhm.
Or is it this other new thing? And when you're trying to not have a lot, even if it's not
Right.
just a set number, it really does change. It raises the bar for like what gets
Mhm.
in. And I think it makes you a better decision maker, I think.
Yeah, well, it makes and I remember as you get past 40, to me, the decisions get much harder. And and what happens is I think you define a little bit more of what's my circle of competence, what stocks do I enjoy following, what's really important to me. And so part of that getting from 100 to 20 is I had to put together a an investing checklist that says, how the heck am I going to make these decisions and hold myself accountable for sort of what I'm doing? And that's been super helpful.
Brian, it's interesting. You mentioned, you say the decisions are harder. And I think part of it is we see this professionally as well. The decisions get bigger as you move up
Mm,
your through your career pipeline, and it's the same way when you're managing your own investing portfolio too. Is something worth 10% of your portfolio when you're 35 versus when you're 5 or 10 years out from retirement? The percentage is the percentage, but that number gets really big, right? And the decisions start to get kind of heavier. So, one of the things I think would be interesting to talk about is, as you think about, you've clearly become comfortable making those concentrated portfolio decisions. 20, less than 25 stocks. We're talking your smallest average position still going to be 4% of your portfolio, like
mhm.
on average, right? When a lot of people, like 0.4% might be your starting position in a stock. So there's an order of magnitude right there. But what I'm interested to hear you talk about is how you think about it in terms of dollar amounts versus percentages. And let's start talking a little bit about, as we get closer to the end, the income side of the portfolio that it's generating. What exactly are you looking to generate?
Yeah, definitely that as your portfolio grows, you have to get it's something that's actually taken me a while to get comfortable with is look back. I remember when I first started in 2004 and there was a certain number I had with a fully invested position. Today that number is 20 times bigger than it was back in 2004. And so one, it's I don't recommend that people start to reduce the number of stocks that they own until they're much more comfortable with how am I making my, having a structured, organized decision process on how am I making this decision? What am I doing? Because the gunslinger Brian of his 40s dealing with the kind of portfolio that I have today would have been disastrous. So, but yes, the numbers are a lot bigger. And when you talk about income, I don't have what we talked about today. I'm 23% of my portfolio value is in dividend stocks. I don't have a target percent. I don't want to get to 50 or whatever, but the dollar number that I want, there's a certain dollar number that I want. And one of the
So
Thornburg.
dollar number in the value of the portfolio, or the dollar number in dividends?
So what's interesting is I am looking for a specific dollar number. I'm anchoring on a dollar number of income producing stocks, and the rest I don't care. The rest is sort of gravy because eventually I want that income producing to be probably some around 70 to 80%. I have no pension. That actually there's a small thing that I'm gonna get. I'm not really counting on Social Security, so really the stock portfolio is gonna fund the retirement. So I
Yeah.
want about 80% of my expenses to be covered based on dividends that come out of the portfolio.
Yeah,
And
I love that idea because the benefit, just in case it's not obvious to everyone listening, of generating a lot of dividend income in retirement is then you don't have to sell as many or maybe
right.
even any of the actual stocks. You can just live off, I mean, 80% you probably will end up selling some, but that's what I have in my mind as I try to think about how much I want to start getting into dividend stocks now. Just trying to build towards that because it's such a small part of my overall portfolio.
Mhm.
Because I got such a late start in the individual stocks thing. So I'm really interested to hear that. Yeah.
Yeah, so if you say that, hey, now dividends aren't guaranteed. Just be clear. It's not like an annuity, but generally the companies that are in this, some of my dividend stocks are Home Depot, Hershey's. They've paid increasing dividends over the last 20, 30, 40 years, whatever. It's almost guaranteed. And so there's a set amount of
Ask
income.
anybody that invested a large percentage of their wealth in office REITs,
Oh, oof.
how safe those
Yes.
dividends are, right? It's just
Yeah.
like every other aspect of business ownership. You want to diversify the risk factors that you're exposed to so you can make it as secure as you can.
Yep. And so the idea is, back to this 80% covering my expenses, what happens in the market when I'm retired will be much less of an issue.
You want it to be inconsequential.
I do. I don't want to have 2022 happen when I'm 70
Yeah.
and like freak out that we're going to be, kicked to the curb and the street and I'm going to have to live with my kids.
Yeah, your kids also don't
They
want
don't want that either.
Yeah. No, they told us. They
Right.
said
They did.
And part of how I'm targeting what that dollar amount is, and I hope you'll put the value of dividends study in there. That Thornburg looked at, they did Dividend King portfolio. If you bought in January 1st of 1990, they said put $1 million in and then pull out at the end of the year 50 grand every year for the next 30 years and increase that with inflation. So it's inflation adjusted throughout the 30 years.
Right. So it's the 5% version of the 4% rule.
Right.
You
So
take out 5%.
5% of
of
this
the
$1 million
starting amount.
of this Dividend Kings portfolio of $1 million. And after 30 years, you've pulled out probably $2.5 million worth of money to use for to fund your life. And the portfolio, let me get the number. I want to say $15.5 million at the end.
So last I checked, both 2.5 million and 15 and some odd million are more than 1 million.
Yes.
wait,
Yeah.
hold on. Wait, I'm just gonna nope, you're right. Yeah, I just checked.
Okay.
Yeah.
Thanks, Jeff. You had me nervous for a second there.
So this Thornburg article was just like the light bulb went on. And I'm like, this is really, this is kind of what I want to model after.
Yeah.
And so I used that $1 million and the 50,000, I scaled it to the number that I want. And so that, hopefully you guys will put that in the thing. That's something
Yeah.
that as people getting into dividend stocks, that's a great way to think about the power of dividends.
We'll have this in the transcript, not the show notes. You have to go find the transcript now, people. That's the deal. That's the deal you're making with us. I want to say this is kind of my closing thought before we wrap things up, and you can share a little bit about where our listeners can find you and two other guys named Brian. This is a perfect example of, like, as you're picking individual stocks, there's a certain period of time where your aspiration absolutely needs to be, if I'm going to put in the time and effort and energy to do this, I need to outperform an index. I need to do better than the S&P.
Mhm.
Like, if I'm not, I just need to go buy the ETF and then I can
Right.
go do something else to make money or spend more time playing golf or whatever. But you're in that phase now where you have like actual tangible financial goals, and your focus right now is laser focused on reaching those goals
Mhm.
no matter what the market is doing.
Right.
That is so important. And that's the position that I can see it like so close for me, that for people to be in that position, guys, you're doing it right. You're doing it right when you get there, Brian.
Well,
Brian,
and
you're
I
doing it
know
right.
that if you had told me that 10 years ago, I wouldn't have believed you.
Yeah.
It's so, I think one of the things you guys threw out at me as beforehand is there anything that you would do different?
Yeah.
And I would encourage you, if you're in your 30s or in your 40s, to start dabbling a small percentage of your portfolio. It doesn't have to be big, 5, 10%, and start to look at investing in income producing stocks. If
Yeah.
you guys are all individual stock or even just an index. Because the other thing that happens is not only for this Dividend Kings example, the stocks grew. So it's not like the stocks are zero growth. The stocks actually grew in value. And at the same time, the dividends grow as well.
Yeah.
And so I remember meeting a guy at one of the Motley Fool events, and I was asking him about his portfolio. And I said, well, how many stocks do you own? He said 2. I'm like, what? Are you kidding me? And I think he said he bought Amazon and Microsoft, and maybe not Amazon. There was another company. I don't remember the second company, but Microsoft, he bought it in the 80s, and he only bought a couple $1,000s worth. And he said, I'd never sold a single share. And he said,
That's worked out.
well, yeah. And he said, what's interesting is that his quarterly dividend check that he gets is more than his original cost basis.
Oh yeah. Yeah.
It's just insane.
Yeah.
And so that power of the dividend is coming from a diehard growth investor for the last 20 plus years. That's amazing. And so to me, there's nothing more than experiencing it. You can see it on paper with a Thornburg study. That won't do it for you. But if you buy a dividend stock today, I remember I owned Home Depot 20 years ago or 15 years ago or whatever. And I was like, I sold it after a year and I'm like, this thing's going nowhere. I'm tired of this thing. And
That's what we call a bullshit reason.
yes, that's definitely a bullshit reason. Right. But what I didn't realize is I wasn't counting the dividend. I didn't see it. It was a small number. It didn't matter. But yeah, so I would encourage you, if you're in your 30s or 40s, to dabble a little bit in dividend stocks and reinvest them and just see what happens. And picking out dividend stocks is quite a bit different than picking out growth stocks. But I'm a changed man. I will never give up my growth side, but definitely this dividend stuff is going to make it so that I don't have to worry about the market on a day-to-day basis. And that is it's a great sleep at night factor.
And that's good to hear, because when you're at the beginning of your stock buying journey, whether you're young and that's just the beginning of your investing journey, or you're like me and there's 20 plus years of index funds behind you, but you're just starting to buy stocks, it's really hard to wrap your head around the fact that the 13 cents you get a quarter from the couple $100s of the stock you own can, over time, with buying more in decades and decades, turn into actual real money that can change your life. The most tangible example I have is there's two older people who I've known in my life who have now passed. One was my grandmother and one was the great aunt of a friend of mine, who both were not investors necessarily, but these are people who lived through the Great Depression and World War II and all that stuff. But they either inherited or had just a little bit of money in maybe just one company, because it was the company their husband worked for.
Right.
And now here they are in their 80s, just living off dividends, almost all of their income off of, and it wasn't ever literally planned that way, but it just shows you what decades and decades and decades of not selling dividend stocks can do for you. So I think we're pretty much at the end of the questions we wanted to ask, but we want to give you an opportunity, Brian, to let the good people know where they can find you, where they can find long-term mindset, and, share any information you want about what you have going on.
I'm in a business with 2 other Brians, Brian Feroldi and Brian Stoffel, and was so excited that I think they asked me to join, not just because my name was Brian, but I actually brought skills to the team. So
You can think that,
but mostly because your name's Brian.
yeah, mostly out of the universe of Brians, you were one of the options.
There we go. But yeah, so you can check us out. We have a weekly newsletter. It's a quick and easy read. Stoffel writes the intro every week, and then we share a resource, a Twitter thread, a helpful infographic, and a couple other things. And it's just a super easy read and kind of keeps you connected. We don't think we invent all the greatest content in the world, and so we share the things that we find that are helpful to all investors. But yeah, you can check us out. Our website is longtermmindset.co. If you put in com, nobody owns that one, but they wouldn't let us buy it for whatever reason. So, but you can put your email in, and you'll get on our newsletter.
We'll have a link in the show notes and also in the transcript, and we'll have a special code that you can get it for absolutely free. It's free. There's not a code.
Yeah, I was gonna say that's 100%
free.
off what the current price is.
That's right.
Yeah.
It's going to be freer.
Yeah.
With our code. Well, I just want to plug what you guys are doing too. What I like about the regular newsletter kind of reminders is kind of how I think of them is like you forget these things. Like you talk about them and they're like, oh yeah, I remember that. These are things I should keep in mind. But like having it in your inbox, like you said, keeping you connected, and I think that's a good way to think about it. It's just a nice kind of daily reminder or weekly reminder, whatever. I forget what the cadence is of the
Yeah, they're
emails,
Wednesdays at 9 a.m. So.
Okay, so it's like just a weekly reminder that keeps you grounded, and it's just like drives home those universally, known facts about investing that I think makes everyone a better investor.
Awesome.
So normally this is the part of the show where I would say, Brian Withers, thank you for coming on with us, but I'm not going to. Somebody else is going to say it.
Thank you, Brian Withers.
Much for coming
Tate.
on. There you go. There you go. Yeah, this was great. Great conversation. Look forward to having you back on again sometime.
Awesome.
Bye.
Totally fun. We should do it another 18 months when my portfolio goes up another 60%.
And we'll call this the Brian Withers Retirement Show. There we go.
I don't know. So the whole retirement thing, we're still trying to figure out what the heck.
Don't do it. It's overrated. It's overrated. That's my suggestion. Okay. Once again, Brian, thank you so much for coming on. We'll have plenty of links in both the transcript and in the show notes for folks looking to find Brian, the study that he mentioned, all that kind of stuff. So in the meantime, I'm going to remind you, Brian's answers, just like mine and Jeff's, they're our answers. They ain't your answers. Try them on if you want to, but then you have to make sure they fit on your own. Find your own answers, friends. You can do it. I believe in you. All right, Jeff, friend, we'll see you next time.
See you next time.
See you next time.